The first idea is that retirement withdrawals should begin with spending categories, not products. Necessary living costs, housing, insurance, healthcare, taxes, and basic food do not behave like travel, gifts, hobbies, upgrades, or optional support. If all spending comes from one portfolio under one fixed rule, a market decline makes it hard to know what must be protected and what can be delayed. Bucket 1 is the basic spending bucket. It covers 1 to 2 years of necessary living costs. Its goal is not the highest return. Its job is stability, access, and low volatility. It may include checking balances, savings, short deposits, money market tools, or other conservative instruments that the household understands. This bucket helps retirees avoid selling volatile assets during a weak market just to pay ordinary bills. Bucket 2 is the defensive reserve bucket. It is not daily cash, but it supports spending that may be needed within the next 3 to 5 years. It can accept slightly more term structure than the first bucket, but it still needs quality, maturity planning, liquidity, and reinvestment awareness. Its job is to buy time for the growth bucket, so a temporary market decline does not become a lifestyle emergency. Bucket 3 is the growth and flexibility bucket. It carries longer-term investment risk, fights inflation, and supports spending beyond the near-term reserve. It should not be forced to sell every month regardless of market conditions. When markets are strong and rebalancing creates gains, Bucket 3 can refill Buckets 1 and 2. When markets are weak, the household can reduce flexible spending and give this bucket time to recover. The 3 buckets are not 3 products. They are 3 jobs. Cash, bonds, funds, stocks, pensions, annuities, and other assets can each serve a role depending on timing, risk, tax treatment, and household needs. Every bucket should answer the same questions. When will the money be needed? How much volatility is acceptable? And would a market decline force a bad sale? The biggest problem with a fixed withdrawal rate is sequence of returns risk. If a retiree sells assets during a bear market in the early retirement years, the portfolio can be damaged before it has time to recover. If early returns are strong, the same rate may look safe. The problem is not only the percentage. The problem is whether the withdrawal rule has a break during weak markets and a refill rule during strong markets. An annual withdrawal process can use 4 steps. First, list next year's necessary spending and flexible spending separately. Second, check whether Bucket 1 has enough cash. Third, check whether maturities or income from Bucket 2 can refill Bucket 1. Fourth, review Bucket 3 and decide whether rebalancing can refill reserves, whether spending should stay stable, or whether flexible spending should be reduced. A safer sequence is to refill Bucket 1 to the target number of months, refill Bucket 2 to the target number of years, and only then consider higher flexible spending or gifts. If every strong market permanently raises spending, the next decline will require a much harder adjustment. In a weak market, the withdrawal rule needs a defensive version. It is a planned way to give long-term assets recovery time. Retirement planning is not about never adjusting. It is about knowing which spending can adjust, when, and for how long. Inflation also matters. If every spending item rises automatically each year, portfolio pressure can become too high. If nothing adjusts, purchasing power can erode. A better rule separates necessary spending from flexible spending. Basic living costs may need inflation adjustment. Flexible spending can be tied more closely to markets and household conditions. The household should look at actual categories, not only an average inflation number. Health and care spending should be marked separately. The spending that breaks a retirement plan is often not normal groceries. It may be medical care, long-term care, housing repairs, family support, or a large tax bill. If these items are not marked in Bucket 2 or a dedicated reserve, they may force sales from Bucket 3 at the wrong time. The withdrawal map should show known large spending dates. Taxes can change the withdrawal order. Different accounts, pensions, dividends, bond interest, annuities, and funds may have different tax treatment. A withdrawal plan should compare pre-tax and after-tax cash flow, income brackets, benefits, and family arrangements. This video is not tax advice, but it is a reminder that the cash available to spend is not always the same as the gross withdrawal. Do not treat dividends or distributions as completely safe withdrawals. Cash payments can help, but payouts can change and asset values can move. If the plan looks only at distribution amount and ignores total return, concentration risk, and principal changes, the household may feel stable while the balance sheet weakens. Income is useful, but it does not replace a withdrawal rule. Too little cash creates risk, while too much cash creates a cost. Too little cash can force sales in a downturn. Too much cash can lose purchasing power to inflation over many years. The target reserve should reflect pension income, insurance, health risks, market volatility, family support needs, and emotional tolerance. No single month count fits everyone, but every household should know its reason. The defensive bucket can use a maturity ladder. Divide future spending across different maturity dates so all reserve money does not need to be reinvested on the same day, and so the household does not lock too much money away for a tiny yield difference. The purpose of the ladder is predictable. Cash flow, not yield chasing. Product choice depends on local rules, taxes, and risk. The growth bucket needs a rebalancing rule. When risk assets rise sharply, sell a portion to refill the first two buckets. When markets fall and the first two buckets are adequate, avoid selling growth assets too aggressively. Rebalancing is not a market prediction. It is a way to keep money assigned to its job. This connects investing discipline with withdrawal discipline. Households should write the rule in plain language. Which bucket pays which expense? Who monitors the accounts? How large a market decline triggers a family review? How much flexible spending can be reduced? If the primary planner becomes ill, can another family member understand the map? A retirement withdrawal system should be executable by the family, not only by the person who enjoys spreadsheets. A simple 4-light dashboard can help. Green means the first two buckets are full and the growth bucket is healthy. Yellow means markets are weak or cash is below target, so spending is reviewed. Red means repeated declines, higher health costs, or an excessive withdrawal rate require a full plan revision. Blue means markets are strong, so the first step is to build future buffers before permanently raising spending. Do not separate withdrawal planning from asset allocation. If the investment portfolio is volatile, the cash and defensive buckets need to be stronger. If the family still has debt or dependents, reserves may need to be thicker. Allocation should serve the withdrawal task, not only chase return rankings. A withdrawal rule should not be frozen for 30 years. Early retirement, mid-retirement, and late retirement can have different spending patterns. Travel and hobbies may be higher just after retirement. Later, spending may stabilize. Health and care costs may rise after that. The bucket map should be reviewed at least annually and after major market, health, family, or tax changes. If retirement is still years away, rehearse the process now. Divide expected retirement spending into basic, defensive, and flexible categories. Then test how long current assets could support each bucket. This is more useful than asking only for one retirement number. The number is a starting point. The withdrawal process is the operating system that keeps the plan alive. A practical plan should also distinguish spending that is emotionally important from spending that is legally or physically necessary. Some flexible spending may still matter to quality of life, so the adjustment order should be discussed before a crisis. Stable income sources such as pensions, rent, annuities, or part-time work can reduce portfolio pressure. Put them on the same cash flow map as withdrawals because every reliable dollar of income changes how much the buckets must provide. The plan should include a handoff document, account locations, withdrawal rules, contact information, tax documents, and family decisions should be visible to a trusted person. Retirement cash flow is partly a family operations problem. Avoid judging the plan by one market year. A strong year does not prove that the withdrawal rate is permanently safe, and a weak year does not prove the plan has failed. The process matters more than one annual return.